In this video, we're going to be putting supply in together to find our market equilibrium. Market equilibrium is going to be a point in our market where buyers and sellers agree with each other. At a particular price and quantity, there's the same number of buyers as there are sellers. On a graph, here we have our supply curve, downward sloping demand curve, and this point where they intersect with each other, this is going to be our equilibrium point. That's going to be represented with P star and Q star to show that it's the equilibrium, the one point on the graph where buyers and sellers agree with each other. Market equilibrium is always going to be the point where the quantity supplied is equal to the quantity demanded. So if we're looking at a graph here, you find the middle of this X, the point where these two lines intersect each other. On the next slide, we're going to see how we can use equations to solve for this point. If we're looking at a table, you would find a particular price that has the same quantity supplied as the quantity demanded. So our market equilibrium is going to be where our buyers and sellers agree with each other. Buyers and sellers have the same reservation price at a particular quantity. So in this example, our equilibrium quantity is 60 and our equilibrium price is 6. So at a quantity of 60, our buyers have a reservation price of 6. And at a quantity of 60, our sellers have a reservation price of 6. So we say our equilibrium price is $6, equilibrium quantity is 60. Now here, we are not saying that we're not saying that supply is equal to demand, because that would be saying that the entire supply curve is the same as the entire demand curve. And that's not the case. What we are saying though is that at this equilibrium, the quantity supplied is equal to the quantity demanded. So there's one point on the supply curve that is same as one point on the demand curve. The equilibrium is going to be the most efficient price and quantity because it's leading to the maximum economic surplus. Economic surplus is telling us how much benefit our buyers are getting that they didn't have to pay for, how much profit our sellers are getting above their costs of production. And we want to try to maximize this economic surplus as individuals and as a society because it means we're getting the best use out of our resources. Now, we are going to talk in other videos about potential market failures where this point might not be the most efficient with things like fraud or pollution. There are sometimes when government intervention is required to actually make markets more efficient. But assuming that the market's working the way it's supposed to, all relevant costs and benefits are included in these supply and demand curves, then this equilibrium point is going to be the most efficient. It's going to be maximizing those benefits to society. So on the last slide, we saw that you can find the equilibrium by looking at the graph. You just find the point where supply and demand intersect with each other. We can also solve for the market equilibrium using algebra. For this, we're going to need two equations. First, we're going to need the demand curve equation. This is going to tell us that the slope of the line, it's going to be downward sloping. So here we see this first equation. Price is equal to 16 minus Q2QD. So in this case, it's quantity demanded. So we can plug in different values for the quantity and find out the price. Or plug in different values for the price and find the quantity. This negative here tells us that it's a demand curve. So minus Q. We have a downward sloping demand curve. We also have a supply curve equation. Price is equal to 4 plus 4QS, or quantity supplied. Notice that it's positive here, plus 4Q. That's because supply curve is upward sloping. At our equilibrium point, quantity demanded, QD, is equal to QS. So when we're solving for our market equilibrium, we're really looking for Q star. That one point where the quantity supplied and quantity demanded is equal. In algebra, whenever you have two different variables you're trying to figure out, you need to have at least two equations. So in this case, we are trying to figure out Q star and P star. And luckily, we've got two equations here, demand and supply. And since we're only interested in the one quantity where our buyers and sellers agree, when solving our equilibrium, we can turn QD into Q star, and we could turn QS into Q star. So now we have two variables, P and Q, and we have two equations, the supply and demand curve. So what we're going to do is we're going to take the right-hand side of each equation and set it equal to each other. So 16 minus 2Q is equal to 4 plus 4Q. And we're going to put Q star here instead of QD or QS, because at this one point, they're the same number. Then we want to solve for this. So we need to move all of the Q's, the variables, to one side and all of the numbers to the other side. So we're going to add 2Q to both sides, which basically on this left-hand side makes our quantity 0, and on the right-hand side it makes it 6Q. And then we want to move this 4 over to our other side of the equation, so that we only have 6Q on the right-hand side. So we would say subtract 4 from both sides. And that way we would get 0 plus 6Q here, and 12 plus 0Q on the other side. So move all the letters to one side, all the numbers to the other, which means you have to do the opposite of whatever the sign is. So here with this negative Q, 2Q, we added 2Q to both sides. Since we're trying to move the 4 from the other side and it's a positive number, then we subtract 4 from both sides. Then we want to divide. Okay, so we've got 12 is equal to 6Q. We want to know what Q is. Right, what is Q star? So to get that, we're going to divide both sides by 6. And we're going to get that our equilibrium quantity is 2. Q star equals 2. We also want to know what our price is. Now to get our price, we can actually just plug that back into either of our original equations. We'll have one variable, one equation, and then we can solve. Okay, so plug your value for Q star into either the supply or demand equations and solve for P. So let's say we're putting it into our demand equation. We would say 16 minus 2 times 2, because 2 is our equilibrium quantity. So 16 minus 4 is going to give us a price of 12. If we plugged it into the supply equation, we'd get the same thing. 4 plus 4 times 2. So 4 plus 8 is equal to 12. So you should get the same price when you plug it in to both the supply and demand equations. If we were looking at this on a graph, we had supply and demand like this, price, quantity, then this, where this X intersects, this would be at a price of 12, and a quantity of 2. So here's what it would look like on a graph. If we had a table with a bunch of different points on it, so let's say we had price here, 10, 11, 12, 13, and then quantity demanded and quantity supplied. So at $12, both of these things would have a quantity of 2. Our market equilibrium is considered stable, meaning prices are going to automatically adjust if our sellers set it too high or too low. Ideally, it would be nice if each company just had access to this graph. It would tell them exactly what price to set, exactly what quantity to produce. But a lot of times it's just trial and error. They look at market data, they look at different research telling them what the price is going to be or how many they think they'll be able to sell, and then they kind of guess. Sometimes though, places guess wrong. Farmers guess wrong, landlords guess wrong, ice cream shop down the street guesses wrong. And when that happens, they could potentially end up with a surplus or a shortage. This is an indicator to them that they did not set the price at the equilibrium. Then businesses will adjust. They'll change their prices until they get to a point where the amount they plan to sell agrees with the amount of customers that they have. A surplus is going to be any time price is above our equilibrium price. We're going to have more quantity sold than quantity demanded. So that would be like this top graph up here. There was some equilibrium price in this market. Our farmer set the price a little bit higher. So maybe the price was supposed to be $50 per bushel, and they set it at 60. So when prices were at 60, the quantity demanded was a little bit lower, and the quantity supplied was a little bit higher. So we get a surplus because our quantity demanded is less than our quantity supplied. So a surplus happens at a particular price when there's more quantity available for sale than there are people wanting to purchase it. When companies, when businesses, when farmers have a surplus, they have a bunch of extra stuff that they didn't sell. So two things happen. First, they often will cut the price, right? They'll offer a discount. They'll have a sale to try to get rid of that excess. The second thing that's going to happen is next week or next month or next year, they're going to reduce production because they know that prices need to be a little bit lower. And since we have an upward sloping supply curve, when prices drop, firms know that they need to have a lower quantity. So we're going to get a discount right now to sell off that surplus. We're going to produce less next year and then charge a lower price. A shortage happens when the price is below our equilibrium price, below P star. That's where we've got more buyers than sellers. So in this example, price is lower than equilibrium. So our quantity supplied is going to be less than our quantity demanded. Right? A1 is less than A2. So a shortage happens anytime companies set prices lower than what that equilibrium price should be. How do companies respond to this? Well, first, there's a shortage. Maybe they have a line around the block. There's lots of people trying to buy their stuff. They sold out before they were planning to. So they could do two things. They can raise the price. Right? They know that this is in high demand. If they have any left over, maybe they notice a huge line forming, they start raising the price immediately. But also it means they're going to produce more stuff. Right? So next week or next month or next year, they're going to increase production because they know that this market can handle a higher price, and now they're willing to supply a higher quantity. And so quantity supplied is going to increase, prices are going to increase until we get back to that equilibrium point. So we would say that equilibrium prices are stable. We either end up with a surplus or a shortage if the right price isn't chosen by our companies. That's going to signal to them that they need to change prices and they need to change quantity. And so we say that markets are going to naturally move towards that equilibrium. Equilibrium prices can change. So anytime we have a shift in our supply or demand curve, we're going to see that we have a change in our equilibrium price. So let's look at what happens with a shift in the demand curve first. Let's say this is a market for coffee. So our current equilibrium price for a cup of coffee is $4. We have an increase in consumer income, and coffee is a normal good. That's going to shift our demand curve to the right. Now, at our new demand curve, we reach a new market equilibrium price and quantity. Now, our new equilibrium price is $5. And maybe our quantity before was 100, and now our quantity is 150. So an increase in demand is going to cause both price and quantity at the equilibrium to increase. increase in demand, P star and Q star are both going to increase. If we have a decrease in demand, maybe taste and preferences have changed. People don't like coffee as much, so they decrease their demand. Now we have a price of $3, maybe a quantity of 50. So when demand decreases, shift to the left, our equilibrium price and quantity are both going to go down. We can also have a shift in our supply curve. Say this is also the market for coffee. We're going to say demand is staying the same. Nothing about our buyers' preferences or incomes or related goods is changing. So if their market starts out at $4 for a cup of coffee with a quantity, equilibrium quantity of 100. Let's say we have an increase in supply. We have more coffee suppliers entering the market. So our supply curve is going to shift to the right. If we have an increase in supply, that gives us a new equilibrium point where we have a lower price and a higher quantity. So P star is going to decrease, Q star is going to go up. We could also have a decrease in the supply curve. So a decrease in supply, maybe input prices went up. There was a drought this year and it was difficult to grow the coffee. So the coffee beans are more expensive. So a decrease in supply, this curve is shifting to the left, is going to result in a higher price and a lower quantity. So decrease in supply curve, price goes up, our equilibrium quantity goes down. So even when we don't have these curves in real life, we can look at the behavior of markets. We could say, oh, prices are going up, quantities going down. This must be caused by supply, things happening on the supply side. Or we could say prices are going up and quantities going up. This must be something that's being caused by the demand side. We can also have scenarios where both curves are shifting at the same time. We can have increase in supply and an increase in demand, or an increase in demand and a decrease in supply. Both curves might move at the same time. When both curves are shifting at the same time, some of our results or predictions might be ambiguous if we don't know the size of the shift. For instance, a decrease in supply usually causes the price to go up and the quantity to go down. And a decrease in demand also causes the price to go down and the quantity to go down. So when both supply and demand are decreasing, we know for sure that we will have a decrease in the equilibrium quantity because both of those things cause the quantity to go down. But what's going to happen to the price? Well, it depends. Which effect is going to be stronger? Because a decrease in supply is going to cause price to go up. Decrease in demand is going to cause price to go down. We could end up with the same price. We could end up with an increased price, or we could end up with a decreased price. If we know supply and demand are both going to be going down, our prediction for price is question mark. It's ambiguous. We don't know what's going to happen. Same thing if there's an increase in supply and an increase in demand. We for sure know that the quantity is going to go up, but we're not really sure what's going to happen to the price. If supply and demand are moving in opposite directions, we can predict the price, but we're not quite sure what's going to happen with the quantity. For example, if we have an increase in supply, we know the price is going to drop and the quantity is going to go up. And a decrease in demand, we know that the price is going to drop, but that the quantity is going to go down. So for sure, we know the price is going to go down, but we're not quite sure what's going to happen with the quantity. Once we see the shift on our graph, we can then say what actually happened. Or if we have two new equations and we're solving it with algebra, then we can say what happened with the price and quantity. But if we can't visually see it on the graph and we don't have the equation data, when we're trying to predict what's going to happen, we may end up with an ambiguous price change or an ambiguous quantity change, depending on what's happening with these curves in each direction. That's going to be the end of this video. I will see you next time when we go a little bit deeper into our market analysis.